Welcome to Furniture Industry News. Today is April 16th, 2026. Thanks for joining me. There's a lot moving in the industry right now, and while nothing feels overly dramatic on the surface, when you step back, you start to see some clear patterns forming. We're seeing financial pressure in parts of retail, steady but uneven demand, some meaningful restructuring at the supplier level, and a few bigger shifts that could reshape how the industry operates over time. Let's start with retail, where we're seeing signs of stress showing up in different ways. A regional player out of Texas, Supernova Furniture, has filed for Chapter 11 protection. The company operates 6 stores in the Houston area, along with a distribution center, and in its filing, it reported relatively minimal assets against liabilities that range from about $1 million to $10 million. What stands out here is not just the filing itself, but the list of creditors. It includes a wide range of well-known suppliers across the furniture industry. That suggests the impact could ripple outward, at least in small ways, depending on how things play out. At the same time, on a much larger scale, QVC Group is preparing to file for Chapter 11 as well. This is the parent company behind QVC and HSN, and they're looking to restructure more than $5 billion in debt. The expectation is that they'll move through the process in about 90 days and continue operating as they do. Now, while QVC isn't a traditional furniture retailer, it's still part of the broader retail ecosystem, and the reasons behind the filing are worth paying attention to. They've been dealing with shifts in consumer behavior, especially as more shoppers move away from traditional cable and toward digital platforms, where price comparison is instant. On top of that, rising marketing costs and inflation have added pressure. So when you look at both of these situations together, it points to something bigger. Different types of retail models are being forced to adjust to a more competitive, more cost-sensitive environment, and that's something that affects everyone in the industry, directly or indirectly. Now, even with those pressures, consumer spending overall is still holding up.
Retail sales in March increased for the 6th straight month. Total retail sales were up slightly month over month and showed solid year-over-year growth as well. A big part of that was driven by early tax refunds, which gave consumers a bit more room to spend. But when you zoom in on furniture, the picture is a little different. Furniture and home furnishing sales were actually down slightly from the previous month, even though they were still up year over year. And that pattern has been pretty consistent lately. Consumers are still spending, but they're being more selective about where that money goes. They're focusing on essentials, managing higher costs, and in many cases, putting off larger purchases. So for furniture retailers, that translates into demand that's there, but not always predictable. Some categories might perform well, while others lag behind. It's not a broad-based surge like we've seen in previous cycles. And then you layer in what's happening with housing, which continues to be a key driver for our industry. First-time home buyers have dropped to their lowest level in more than 40 years. Right now, they make up just 21% of all buyers. That's a meaningful shift. Affordability challenges and limited housing inventory are making it harder for younger buyers, especially millennials, to enter the market. And that matters because first-time buyers tend to drive full home furnishing purchases. Instead, what we're seeing is a larger share of activity coming from older buyers, particularly baby boomers. Many of them are purchasing with existing equity, and their buying patterns tend to be more selective. They're not always starting from scratch. They're upgrading, replacing, or downsizing. So the net effect is fewer of those big whole home opportunities and more incremental demand. It's a subtle shift, but it has real implications for how retailers plan inventory and sales strategies. Now, on the supplier side, we're starting to see how companies are adjusting to this environment. Hooker Furnishings reported a return to profitability in its most recent quarter. It wasn't a huge number, but it's a meaningful change from where they were a year ago when they were operating at a loss. What's interesting is that this improvement came even as sales were down more than 20%. So this isn't about top-line growth, it's about restructuring.
They've been reducing costs, simplifying their portfolio, and tightening up operations. They've cut fixed costs significantly, reduced inventory by over $17 million, and divested some lower-margin businesses. The takeaway here is that suppliers are adapting. They're recognizing that demand may not bounce back quickly, and instead of waiting for that, they're making internal changes to protect margins and stabilize the business. That kind of discipline is likely to become more common if current conditions continue. Now, shifting gears a bit, there's also a bigger structural change happening in the bedding category that's worth paying attention to. Somni Group International is bringing Leggett & Platt into its structure, and while on paper it might look like just another acquisition, it represents something more significant. For years, Leggett operated as a neutral supplier. It sold components across the industry without competing directly with its customers.
That neutrality is now gone. Somni Group already controls major bedding brands and retail channels, and by adding a key supplier into the mix, they're extending control further up the value chain. This kind of vertical integration isn't new, but it does tend to change behavior over time. Competitors may start looking for alternative suppliers. Relationships may shift gradually. It doesn't happen overnight, but over the course of a few years, it can reshape how companies source products and compete in the market. And finally, we have to talk about the broader global environment because it's starting to create additional pressure points. The International Monetary Fund has lowered its global growth forecast for this year, citing increased conflict in the Middle East and disruptions to key shipping routes. One of the biggest concerns right now is the situation around the Strait of Hormuz, which is a critical pathway for global commodities. Disruptions there are already affecting the flow of materials and driving up energy costs. For the furniture industry, that matters because it impacts inputs like plastics and aluminum, which are essential in manufacturing. As those costs rise, they can put pressure on margins all the way through the supply chain. Even if conditions improve in the near term, there's a chance that companies will continue adjusting their supply chains based on what they've learned during this period, and those changes could stick.
So when you look across everything we've covered today, it's not one single issue driving the industry. It's a combination of factors. Retail is adjusting, demand is steady but uneven, housing is limiting new growth, suppliers are restructuring, and global conditions are adding uncertainty on the cost side. None of this points to immediate disruption, but it does suggest that the industry is in the middle of a transition. And for most operators, the focus right now is staying disciplined, staying flexible, and keeping a close eye on where things are headed. If you're finding these updates helpful, be sure to subscribe so you can stay up to date on what's happening across the furniture industry.